We begin with the markets and record closes for the three major averages following a softer than expected CPI print. Joining us now, Barbara Doran of BD8 Capital Partners and Eric Freedman of U.S. Bank Asset Management. Great to have you both on a day where we have these record closes for the three major averages as well as the NASDAQ 100. Barb, I mean, you've been pretty bullish over the longer term. What do you think about the market at this level right now, given the fact that it has been so risk on, largely due to data that's been, I guess, bad news being good news? Can we call it that yet?
Right. Well, I think this is a continuing bull market, and there's going to be a point, I don't think we're there yet, where in the short term, we're going to start to question like we did in January, February, is it overbought? How much more can we go? But the fact is, if you look at what's happening in the economy and with interest rates, I mean, the PPI number yesterday was disappointing, but then you had a revision down in the March number. Today's CPI was a nice, pleasant surprise. Fingers were crossed, and we got our good CPI number. And that's really what spooked the market in April. You know, was the worries that the Fed would have to, the inflation was going to resurge, but which I frankly don't see how that could happen since so much was driven by supply chain issues. And wage increases are still up, but coming down. So I think, you know, we're in very good shape, and earnings are what we're going to start to focus on now. We're going to wait. We have another few prints to come in over the next months on inflation, but earnings were good in the first quarter, up 7 to 8%, and we started to see year estimates being raised in April, when typically April is a month where analysts look ahead and you see more revisions down than revisions up. So it's all very encouraging for what we're going to see, and it really speaks about the strength of the economy, and that means earnings, and that means stocks can go up.
And of course, we're awaiting results from Cisco, which tends to be such an IT spending bellwether on the tech side. But Eric, the data over the past month in general, largely, and you could look at retail sales as another example of this just today, has been weaker than expected. It does raise the question about the fact that in the second half of the year, we do see these upward revisions on earnings. There is a very strong expectation in the market that earnings are going to continue to grow at this strong pace. Is it actually sustainable?
We think it is sustainable. We've been bullish. We used some weakness in April to add to both equity positions domestically plus commodities. Those are the spaces that we think investors should have more exposure to. So we think it is sustainable. This is still an environment where on a real wage basis, you're seeing consumers pick up some gains in terms of compensation. You're also seeing a broadening out by sector participation. Lots of good things happening across the pond as well as domestically. So we think that an 8 to 9% earnings growth, which is where consensus is for this year, another 10% for next year is not too much to ask for. So, you know, if you look at the participation by, you know, a variety of different consumer types, both middle income as well as upper income consumers, they remain strong. There's been some marginal weakness from lower income consumers, but also more measured. So the data is still positive. We're still bullish and think this is a good time to add positions. Strength in the bond market, we think, is worth selling. Again, not to get totally out, but this is a good opportunity on lower interest rates to sell bonds and buy some stocks and commodities.
Okay, well, Barb, even especially with all this optimism, U.S. equities are still kind of expensive. So when you're looking at what to buy from here, is it more fixed income at all, international equities, or are you sticking with domestic?
Well, I'm sticking with domestic because, you know, I'm not sure things really are all that expensive when compared to other areas. I mean, right now, the S&P is probably around 20, maybe after today, 21. But a lot of that are the big high growth mega cap names that we always talk about. And even there, you're not seeing valuations out of control. They're not 40, 50, PEs. So I don't think we're all that expensive. And I think, I agree with Eric in terms of it's a nice time to be switching out of bonds because the Fed has signaled they're not going to be raising rates. And now the question is when they will. And if we have a few more inflation prints, this could happen sooner rather than later, but probably not before September, I would think. So I would stick with equities.
Okay. And Eric, you say you're kind of switching out of bonds, but adding to duration in tax-exempt munis. Explain.
Yeah, so a couple of thoughts. One is that if you look at the shape of the curve, that for those clients that have taxable positions, this is an environment where the yield curve on the muni side is more normally shaped. So you're actually seeing an opportunity for investors to add a duration without taking on a bunch of what's called curve risk. Other thing I'd really emphasize is that within fixed income, there's certainly some opportunities in high yield, but I also would say that equal weighted S&P has been the problem child, if you will, that hasn't really kept up with its other large cap brethren. So this is an opportunity, we think, to step into an equal weighted S&P, whether you look at that on an index basis or with respect to managers. That's a spot where the value factor is starting to make some sense. And we think that
Okay.
broadening exposure will benefit clients.